Let me ask you a question. What if I told you that most traders don't lose because of a bad strategy? They lose because they don't know how to manage risk. Think about it. You can have the best trading strategy in the world, the perfect entry, the perfect analysis, and still lose money. Not because your strategy failed, but because your risk management failed. The truth is, successful trading isn't just about making money, it's about protecting the money you already have. Because if you can't protect your capital, you won't stay in the market long enough to benefit from your skill. That's why professional traders never think about profit first. They think about risk. Before they enter a trade, before they click the buy or sell button, before they even imagine the potential reward, they already know exactly how much they're willing to lose. And that's exactly what we're going to talk about in this video. The risk management rules that every successful trader follows, and why ignoring even one of them can be enough to destroy an account. Every successful trader understands one simple truth. Your trading account is your business. And just like any successful business, your first responsibility is to protect it. That's why you should never risk more than you can afford to lose. Unfortunately, many traders do the exact opposite. They risk money they can't emotionally handle losing. Money for rent, money for bills, money they desperately need. And the moment that happens, trading stops being a game of probabilities. It becomes a game of fear. Every small movement in the market suddenly feels enormous. Every losing trade feels like a disaster. And instead of following the plan, they begin making emotional decisions. The pressure becomes too much. That's why professional traders only risk an amount they're completely prepared to lose. Not because they expect to lose, but because they know that losses are part of trading. No strategy wins every trade. No trader is right all the time. Accepting that reality is what allows them to stay calm and think clearly. Because when your survival doesn't depend on one trade, you make better decisions. You become more patient, more disciplined, and far less emotional. The goal is not to win every trade. The goal is to stay in the game long enough for your edge to work. And that starts by never risking more than you can truly afford to lose. One of the most expensive mistakes a trader can make is believing they don't need a stop-loss. At first, it seems harmless. The market moves against them, and instead of accepting a small loss, they tell themselves, it will come back. Sometimes it does, and that's exactly what makes the habit so dangerous. Because eventually, the market doesn't come back. The loss keeps growing. A small, manageable setback turns into a devastating hit to the account, all because one simple decision was ignored. That's why successful traders never rely on hope. They rely on protection. Before they enter a trade, they already know exactly where they'll get out if the market proves them wrong. That point becomes their stop loss, not because they expect the trade to fail, but because they respect uncertainty. No trader can predict the market with 100% accuracy. No strategy wins every time. A stop loss is simply accepting that reality before it becomes a problem. It protects your capital, it protects your confidence, and most importantly, it protects you from the one trade that could wipe out months of hard work. Some traders think using a stop loss limits their profits. In reality, not using one often limits their future. Because the traders who survive are not the ones who avoid losses, they're the ones who keep their losses small. A stop loss doesn't guarantee success, but it gives you the chance to trade another day. And in trading, that opportunity is worth protecting. It's also important to understand that no single trade should ever have the power to change your financial future, whether that means making you rich or wiping out your account. Yet this is exactly where many traders go wrong. They become convinced that one setup is different. This one can't fail. So they increase their position size. They risk far more than they normally would. And without realizing it, they place their entire account at the mercy of one market decision. The problem is that the market doesn't care how confident you feel. Even the best setups can fail. Even experienced traders have losing trades. That's why professionals never allow one position to have too much influence over their account. They understand that trading is a long-term game, not a one-trade game. Their goal isn't to make all their money from a single opportunity. Their goal is to make hundreds of disciplined decisions over time, because they know something many traders forget. If one trade can destroy your account, you're risking too much. Every trade should be small enough that if it loses, you can move on to the next opportunity with confidence and a clear mind. No panic, no desperation, no need to recover everything immediately. Just another trade in a long series of trades. That's how professionals think. They don't build their success on one position, they build it on consistency. And consistency only becomes possible when no single trade has the power to take you out of the game. If there's one principle that every successful trader understands, it's this: protect your capital first. Because without capital, there is no trading. Many traders become obsessed with growing their account as quickly as possible. Every decision is based on how much money they can make. Very few stop to ask a more important question: how do I make sure I don't lose what I already have? Professional traders think differently. Before they think about returns, they think about survival, because they know that opportunities will always come. The market will be there tomorrow, next week, next month, but only if their capital is still intact. That's why protecting capital is always the priority. Sometimes the best decision is to trade smaller. Sometimes it's to stay out of the market completely. And sometimes it's accepting a small loss before it becomes a large one. None of those decisions feel exciting, but they're the decisions that keep traders in the game. The market rewards those who survive long enough to let their edge play out. It doesn't reward recklessness. It rewards discipline. Every dollar you protect today is another dollar that can work for you tomorrow. And that's why professional traders don't chase profits. They protect capital first, because profits always begin with preservation. After a losing trade, the temptation to increase your risk can be overwhelming. You start thinking, I'll just make it back with the next trade. It sounds harmless, but it's one of the fastest ways to destroy an account. Because after a loss, your emotions are already elevated. You're no longer thinking with complete objectivity. You're thinking about recovering what you just lost, and that's a dangerous mindset. Many traders double their position size after a losing trade, believing the next one has to be a winner. But the market doesn't know you lost money, and it certainly doesn't owe you a winning trade. Every trade is independent. It doesn't matter what happened 5 minutes ago, or yesterday, or last week. Professional traders understand this. They don't change their risk simply because they had a losing trade. Their rules remain the same. Their position size remains the same. Their discipline remains the same. Because consistency in risk leads to consistency in decision-making. A loss is simply part of doing business. It isn't a signal to become more aggressive. It's a reminder to stay patient and keep following your plan. The traders who survive aren't the ones who desperately chase losses. They're the ones who accept them, manage them, and move on without changing the rules. That's how accounts are protected, and that's how long-term consistency is built. One habit separates consistently profitable traders from those who constantly struggle. They let their winners grow, and they cut their losers quickly. Most traders do the exact opposite. The moment they see a small profit, they rush to close the trade. They're afraid the market might take it back. But when a trade moves against them, they suddenly become patient. They hope, they wait, they convince themselves the market will reverse. Before long, a small loss becomes a much bigger one. This is one of the biggest psychological traps in trading. Fear causes traders to take profits too early. Hope causes them to hold on to losing trades for too long. Professional traders learn to reverse that behavior. When the market proves them wrong, they accept it quickly. They exit the trade and preserve their capital. But when the market moves in their favor, they allow their trading plan to do its job. They don't rush out simply because they see a little profit. They understand that a few strong winning trades can often outweigh many small losses. That's why they never become emotionally attached to a single position. If the trade no longer makes sense, they exit. If it continues to follow their plan, they let it develop. Because over time, success in trading isn't about avoiding losses. It's about making sure your winners are larger than your losers. That's one of the simplest principles in trading, and one of the hardest for most people to follow. Perhaps the most important shift a trader can make is to stop thinking trade by trade and start thinking long term. Many traders put enormous pressure on every single position. They believe this trade has to work, this trade has to recover the last loss, this trade has to grow the account. And because so much importance is placed on one outcome, every decision becomes emotional. The reality is very different. One trade means almost nothing. It doesn't define your skill. It doesn't define your future. It's simply one result in a long series of results. Professional traders understand this better than anyone. They don't judge themselves by one winning trade, and they don't lose confidence after one losing trade. Their focus is always on the bigger picture. They're thinking about the next 50 trades, the next 100 trades, the next year of consistent execution. Because that's where profitability is built, not in one perfect trade, but in hundreds of disciplined decisions made over time. When you begin thinking this way, something changes. You stop chasing perfection, you stop fearing losses, and you stop feeling the need to be right every time. Instead, you trust your edge, you trust your risk management, and you allow time to do what emotions never can. That's why the best traders don't measure success one trade at a time. They measure it by whether they're following their process consistently. Because in the end, long-term thinking is what transforms trading from gambling into a professional business. So remember this: the goal of risk management isn't to avoid losses. Losses are part of trading. The goal is to make sure that no single loss can take you out of the game. Because the traders who survive the longest are usually the ones who become consistently profitable. Protect your capital, respect your risk, stay disciplined, and think long-term. Do that consistently, and you'll already be doing what most traders never do: Because in trading, it's not the trader who makes the most money on one trade who wins. It's the trader who is still standing after hundreds of trades. Thanks for watching, and I'll see you in the next video.